industry in the East African region seems set for an era of consolidation. Now, the Kenyan banking industry seems to be following the footsteps of their counterparts in Uganda. They've increased the minimum operating capital for commercial banks. Now, for Kenya's case, it is tenfold the increment, that is. And today, for one to operate a commercial bank in Kenya, they will have to have a minimum operating capital of 10 billion Kenya shillings. That's roughly over 300 billion Uganda shillings. Now, we'll be following up that story keenly in our subsequent shows. It is Money and Markets. I'm Charles Boyd, your host. Welcome. Now, for years, the business community in Uganda has always rooted for patient capital, and that is long-term money, which can enable them undertake bigger and fairly large projects. This is because currently commercial banks are holding, by and large, short-term money, which can be withdrawn anytime. And that takes away the luxury of these players to actually extend money to borrowers for a long period of time. Now, in this segment, we're speaking to the deputy chair of PSFU to find out where they're coming from with this argument and what the situation is currently.
The budget casts a positive, optimistic outlook, and we look forward to that growth. 6% since 2016, that is fantastic. But the private sector has been struggling with domestic areas, and we welcome the PSST's revelation today that is now going to settle court awards this year. Otherwise, not every business person who has supplied government is in court. They too should be paid, so we look forward to that. The other one that we welcome big time is patient capital. We've been rooting for this in every room with Ministry of Finance, and we are happy that they have listened to us. They are recapitalizing UDB as well as approving credit lines, a total of over 1 trillion shillings. That is welcome, because business people, it takes a long time from manufacturing, for example, to break even. The other one that we welcome big time also is the funding to missions around the world. We've been commendably engaging with government as partners on integration of markets, on penetration of markets. Why? Because our work at PSFU is research-led. We commissioned an investigation into utilization capacity and the cost drivers of the manufacturing plants. So at 54.4% utilization capacity means you have so much redundancy. And research revealed, that investigation revealed that the highest reason is ineffective demand. So when you have these economic missions, meeting and having us in these rooms engaged in bilateral relations to resolve non-tariff barriers, it means that our products, made in Uganda products, can finally get to these markets unimpeded. We welcome the revitalized cooperation with Kenya. You saw the heads of state, His Excellency the President, witnessing the signing of a cooperation agreement, and agreed that there shall be no more non-tariff barriers. Of course, they also directed their technical people and the ministers to expeditiously handle the remaining pending issues. So we are waiting for that. We welcome the joint monitoring mechanism so that, Ugandans, East Africans can trade and move, export services unimpeded. As a result, because of our good corporate governance, we have several partners around the world, including government, who partner with us. For example, now we are co-implementing with government the GROW project aimed at scaling women's businesses. It is the biggest women's project to have ever been funded in sub-Saharan Africa, $217 million. That is big. So already Private Sector Foundation has moved very fast with the Ministry of Gender to sign MOUs with Uganda Industrial Research Institute to train women to incubate businesses, making soap, adding value to mushrooms, but also the borrowing rate for women in business was capped at 10%, and that is very, very good. But we understand that women, youth need hand-holding to penetrate these regional markets, to penetrate the African Continental Free Trade Area. Without standards, you cannot fight on sanitary standards. So we have also signed an MOU with Uganda National Bureau of Standards to certify businesses owned by SMEs, and also to ensure that more businesses can be, formalized. The other project is MasterCard Foundation. MasterCard, through the lead firm structure over the last 3 years, has enabled the certification of over 500 products belonging to over 200 SMEs in this country. We are engaged in getting our entrepreneurs to the hosting communities of the refugees. You know very well that our country is very welcoming. Our open door policy to refugees has been, lauded by the UN as the best around the world. But they are also a big market. While we may feel the impact as hosting communities around these refugees, we support in trying to sell their commodities to this community, as we also open opportunities to the refugees to get involved in production and other things. So we are that intentional, together with other partners, helping on business development services and readying businesses for export. So we are also leading on corporate governance, so that when a business borrows from a bank, you really ensure that you stick to your business plan. Do not borrow and buy a car. Do not borrow and buy a house. If you're borrowing for a factory, make sure that this instrument, this solution you're being given is put to that. For us, our biggest challenge has been on markets. So the moment these non-tariff barriers are resolved, we were in Dar es Salaam recently, where we presented a matrix of issues to the government of Tanzania and that of Uganda. And we agreed, and they issued a declaration that all non-tariff barriers are going to be resolved. Kenya has resolved. The challenge has always been a state or unilaterally closing borders to our products, so closing borders to the movement of people. So with the East African community now, walk to the impact of those NTBs on businesses and agreeing to say that they are going to now fully implement the customs union and common market protocol, we are game. So the future is optimistic. Two, we look forward to seeing better execution of projects.
Now, the rate of the public debt in Uganda seems to be causing some jitters in some quarters. However, to pundits at Ministry of Finance, there's nothing to worry about because most of this money is being borrowed for high-impact projects. Now, let's find out how this will spur growth and therefore enable Uganda meet its debt obligations. It is now known that the next financial year, government will spend 72 trillion Uganda shillings to meet its obligations. It is also a known fact that part of these funds are going to be borrowed. What is to be borrowed is 9 trillion Uganda shillings, and the bulk of this is going to be raised through commercial banks. The total commercial bank loan book currently is around 21.5 trillion shillings. The historical concern of the private sector, however, is that they are going to be crowded out of the loan market as banks take preference to lend to government as opposed to the private sector. This comes out of the rational thinking that lending to government is less risky since the state is less likely to default on its loan obligations. The banking industry, however, urges otherwise.
Government borrowing is just another form of financing that commercial banks look for. If you look in detail at the financial contract of the financial industry, one of the things you'll be able to pick up is that the larger proportion of loans and advances is skewed towards companies, individuals, and other entities. And from our perspective, what's the government aspirations have to increase domestic borrowing, it's just another vehicle, another instrument that they can use to manage the fiscal policy. Does not necessarily mean that they'll spend all that money.
To Minister of Finance, much of the borrowing will go towards strategic areas with a bigger trickle-down effect into the wider economy.
We are borrowing for high-impact intervention. When you hear these borrowings we are making, projects, budget support is mainly earmarked for high impact. SGR, the refinery, irrigation schemes, infrastructure in industrial parks, transmission of electricity. Because if you transmit electricity and you take it to a certain area, the kind of multiplier effect it brings is amazing. If you open up the railway, you are going to see what is going to happen. It cuts cargo cost by half.
On the way forward, the banking industry remains optimistic about the economic outlook, mainly looking at the macroeconomic fundamentals, despite the challenges including depressed demand for some goods and services.
I think one of the things that we are positive or confident about, if you look at all the macros are strong. If you look at debt to GDP ratio, if you look at interest costs as a percentage of revenue collections, all these parameters are still quite strong. So from where we sit as a banking sector, as a bank that is working in the Ugandan banking sector, we are positive because what it shows is that there is a deliberate growth agenda or desire to stimulate growth, and to stimulate that growth, as government spends more, as government spends on investment. And if you look at the proportion of money that has been skewed towards capital expenditure, investment in roads, investment in infrastructure, it shows you that the spend is being directed in areas that are going to stimulate growth.
So as government looks at mobilizing debt to meet some of its expenditure obligations, the banking industry will have a tough balancing act in determining how much it lends to government vis-a-vis what it keeps aside to extend to the money-hungry private sector currently struggling with a fairly tough economic situation.